Ever wondered why billionaires seem to pay less in taxes than you do? It's not just a feeling. Data backs it up. ProPublica revealed that the 25 richest Americans paid a true tax rate of just 3.4% between 2014 and 2018, lower than what many nurses or teachers pay. How do they pull this off? Mostly, it's not illegal. It's a system of loopholes and strategies only the ultra-wealthy can access. The tax code is a game with two sets of rules, and most of us aren't invited to play. Today, we're breaking down the real strategies the ultra-wealthy use to shrink their tax bills. We'll show you how they make, spend, and pass on their fortunes while keeping taxes to a minimum. Get ready to see the financial wizardry that keeps their fortunes growing and their tax bills shrinking. So grab a drink, something cheap, because you probably paid income tax this year, and let's get started. Title card: The Great Tax Magic Trick. Here's how the magic works. The foundation of billionaire tax avoidance? How they make their money. Most people earn a salary, taxed at rates up to 37%. It's automatic and unavoidable. Billionaires, though, make their fortunes from investments: stocks, real estate, private equity. When these assets rise in value, that's a capital gain. But here's the trick. When they sell, the profit is taxed at just 20%, almost half the top income tax rate. So a hedge fund manager can pay a lower tax rate than a surgeon saving lives. The tax code rewards wealth, not work. The argument: lower capital gains taxes supposedly encourage investment and job creation. In reality, it often just means more mansions and yachts. The tax code has two doors, one for wage earners with a heavy toll, one for capital owners with a friendly wave-through. For billionaires, their entire financial life is structured around that VIP entrance. This disparity is the launchpad for every other strategy we'll discuss. It's why Warren Buffett pays a lower tax rate than his secretary. That's the foundational absurdity. Capital gains are taxed at a lower rate. But what if you could avoid even that? Enter the buy, borrow, die strategy. Imagine you're a billionaire with $10 billion in stock. You want $100 million for a private island. Selling stock triggers a $20 million tax bill. So instead, you borrow against your stock. Loans aren't income, so they're not taxed. You get your $100 million tax-free. You can live off these loans for years, using your growing portfolio as collateral. The interest is minimal compared to the taxes you'd pay, and often deductible. This cycle lets billionaires fund lavish lifestyles without ever selling assets or paying taxes. The bank is happy, the billionaire is happy, and the IRS gets nothing. This isn't a rare trick, it's standard practice for the ultra-wealthy. Their wealth keeps growing untouched by taxes while they spend borrowed money. It's the ultimate financial cheat code. And we haven't even gotten to the die part yet. When they die, the tax magic reaches its grand finale. Let's see how. The engine behind buy, borrow, die is unrealized gains. If your stock goes from $100 to $1,000, you're $900 richer on paper, but you owe no tax until you sell. Billionaires can see their net worth soar by billions in a day, yet report zero taxable income. They use these unrealized gains as collateral for loans, living tax-free while their wealth compounds. This is why proposals for a wealth tax are so controversial. It would finally target these untaxed fortunes. The wealthy argue it's unfair, but really, they're protecting their magic money machine. While you're taxed on every paycheck, their wealth grows in the dark, untouched. The system doesn't just favor the wealthy, it actively subsidizes their fortunes. That's the real phantom menace. Now for the grand finale, die. When a billionaire dies, their heirs inherit assets at current market value, not the original purchase price. That $900 gain from earlier? It vanishes, never taxed. The heir can sell immediately and only pay tax on any gain after inheritance. This stepped-up basis rule wipes out a lifetime of gains tax-free. It's one of the biggest loopholes in the tax code, letting dynastic wealth pass down untouched. Families can build empires over generations, with gains erased at every death. For ordinary families, this might apply to a house. For billionaires, it's billions in stocks and assets. The result? Trillions in untaxed wealth, preserved for future generations. It's not just smart investing, it's a tax code cheat code. The taxman never gets his due. This is how fortunes last for centuries, the final act in the play of tax avoidance. What about the income billionaires do report? Enter deductions and write-offs. For most, deductions are minor. For billionaires, they're a weapon. Charitable giving is the favorite donate appreciated stock. Deduct the full value and avoid capital gains tax. Sometimes they donate to their own foundations, keeping control and getting the deduction now. Business write-offs are another tool. Paper losses from one venture offset profits from another. Trump famously used real estate losses to wipe out taxable income for years. Even personal expenses can be disguised as business costs. Private jets, ranches, lavish parties. The result? Even with taxable income, billionaires shrink it to almost nothing. Their tax returns are Swiss cheese, full of holes. The system rewards those with the means to exploit it. For top executives, the game is all about deferral. Much of their pay comes as stock options or restricted stock units, taxed only when exercised or sold, often years later. This lets them time their taxes for maximum advantage, selling in low-income years or after moving to a tax-friendly state. Deferred compensation plans let them push income and taxes far into the future. The money grows tax-free, and when they finally cash out, they're often in a lower tax bracket. It's like an interest-free loan from the government. Some executives defer hundreds of millions, building massive tax-advantage nest eggs. Regular employees get taxed every paycheck. Executives get to choose when and how much to pay. Their compensation is engineered to minimize and delay taxes at every turn. It's another way the elite play by different rules. After all these strategies, the big picture is clear. The tax code is built to favor owners, not workers. Wage earners are taxed at high, predictable rates. Their contributions are mandatory. Capital owners, though, have a flexible toolkit. Income is what they choose to realize, and taxes are a variable cost. This system is the result of decades of lobbying by those who benefit most. Every time reform is proposed, powerful interests argue it would destroy jobs or punish success. But the reality, the system fuels inequality, concentrates wealth, and starves public services. It creates cynicism and erodes trust in fairness. Billionaires aren't all crooks. They're just playing a different game, with rules designed for them. They own the assets, and the tax code protects and grows those assets. Until we address this design flaw, the spectacle of the ultra-wealthy paying next to nothing will continue. It's a system that values wealth over work, and it's time to recognize that. So there you have it, the billionaire's guide to paying almost no tax. It's a world where income is a choice, and taxes are optional for the ultra-wealthy. The trillions in untaxed gains could have funded schools, healthcare, and infrastructure. When the richest opt out, the burden falls on everyone else. Closing these loopholes and equalizing tax rates isn't radical, it's necessary. If you found this eye-opening, don't forget to like and subscribe for more breakdowns.